History is in the making. The new wave is here. Times are changing and Nvidia is the biggest stock in the world. This was one of my predictions at the start of the year, and today we're going to be talking about Nvidia's implication for the S&P 500, what it means and why it matters, as well as price targets looking ahead and how much more upside is left for the AI giant. Today, we're going to talk about that as well as the labor market. While stocks continue to power ahead, it's important to keep an eye on the glue that's holding this rally together and dive into other measures of employment where things don't look so good to see if it's something we should be concerned about for the rest of 2024. We're also going to be talking about liquidity, earnings revisions, as well as seasonality. What does history say will happen next? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. Truly an historic day for the market. Nvidia now the biggest stock in the world on the back of Microsoft falling 0.5% today, Apple falling 1% today. But the tide is shifting. The new wave is here. AI is probably the forefront of the future, and we're starting to see that with Nvidia. How long can it last? We'll see. I think we're going to go back and forth between Microsoft, Apple, and Nvidia. But for now, Nvidia is the largest weight and the biggest mover in the S&P 500, and that is often bullish because Nvidia trades right now at like 25 times 2026 earnings. I think it's just going to grow into a 30, 35, 40 multiple the closer we get to 2026 into 2025. That means the rally will continue, but a fairly green day across the board. We saw a pretty good day here in software. They've had a real rough go of it, as well as financials. Pretty green day. They took it on the chin last week, so it's good to see this, but it was green overall. Healthcare, industrials, real estate, rate sensitive names. The only stocks that didn't really perform were just, the Magnificent Seven. Let's exclude Nvidia. Look at Microsoft, Apple, Google, Meta, Amazon, Tesla. That's because they've all rallied in the last week and a half throughout 2024. But today specifically, the best performing stock was obviously semiconductors because of Nvidia. But if we actually go down to like what technology did, still positive for the day. Look at the XLK, up 0.13%, but still underperformed the S&P 500. XLC was down 0.59%. Discretionary was down 0.34%. These are the majority of the mega cap names, excluding Nvidia here in semiconductors. Then we had below semiconductors, GDX, XLF, XLI, XLE, XLRE, XME. Very, very simply to see that it was just cyclical sectors and rate sensitive sectors at the top. They all beat the SPY. The SPY returned 0.25%. A fairly positive day across the board. The equal weight was up 0.25%, equal to what the S&P 500 did. Both of these indices, the equal weight and the market cap weight, actually beat the Nasdaq 100, which was still up 0.003% despite all of the weakness we actually saw in the mega cap names. Mid caps were up for the second day in a row, and S&P 600 small caps were virtually flat, although still slightly positive. And again, we are starting to see slight improvements in breadth, sector, and size. What really helped the market today was actually yields. Yields fell significantly, and that was on the back of a 20-year bond auction. We saw very good demand for that 20-year bond auction, and we also got weaker than expected retail sales data before the open, and the 10-year yield fell 1.35%. 30-year bonds fell 2 at 1%. TLT was up 0.92%, and the 94 is acting as resistance, but once we break above, we can look to the 98 level right here. And then on the back of the bond auction, the dollar fell 0.18% and is actually down here in after hours as well. Commodities continue to range. Gold is still at this 2300 level, still in a pretty tight range. Same too here with silver, and crude continues to march higher, crossing the $80 level. But let's actually talk about the S&P 500. Another new all-time daily closing high on the back of yesterday's big move. And we can actually see some very interesting things. Number one, the RSI is actually very, very oversold. Now in the short term, this can lead to, weakness, but if we do stay in overbought territory for quite a while, that in the medium term, that is very, very good because stocks generally just go higher. So bad in the short term, good in the medium term. Overbought conditions aren't necessarily a reason to sell. It's just telling you that people are bullish, especially when they're staying up at these levels. If we actually go ahead, look at the Nasdaq RSI, kind of crazy right there. Very, very oversold, but it doesn't mean we pull back. What could actually happen is we could just trend sideways and then some of these overbought conditions would work its way off. So that's potentially what could happen. But the fact that we are in this overbought territory and staying here is actually more of a bullish sign for the medium term than it is a bearish sign for the longer term. But the S&P 500 5500 continues its grind up to the 5500 level. Remember, that was our goal for June OPEX. We were at 4400, then the core gamma resistance moved up, our target moved up. We're now at the 5500 level. We're pretty much there, and I do see a little bit more downside for the markets, in my personal opinion, than I do see upside, even though we are rallying. I think the absolute upside here is 5500. We might wick above, sure, but what level can we look to downside? I think 5400. This is where the gamma flip is at the moment. So, you know, we're trading in a fairly tight range heading into this OPEX period, but I don't think the market's gonna, you know, particularly fall apart in any big way. I think all dips are going to be bought by this market, especially with now Nvidia being the market leader. And actually, between Apple and Nvidia on a forward earnings basis, it actually is the cheapest stock. I think it's going to grow into its PE over the next year, 6 months, 18 months. So this stock still has, based on its forward multiple of 2026, the stock still has a huge runway to grow into its valuation. So it's probably going to keep marching higher. And I think that's why we've seen quite a number of upgrades here for Nvidia. These guys, Tigris Financial, increased Nvidia's price target to $170 a share. New Street increased their price target to $200 a share. Christopher Rowland increased his price target to $165 per share. Oppenheimer increased their price target to $150 per share. So these all came in today, new price targets for Nvidia, and I think the street's starting to realize that it's cheap on a forward basis, and it's probably going to continue to rally, and the momentum is going to continue. Now, we're definitely not going to see 300-400% returns here over the stock over the next year. You know, a lot of the easy money's been made, but you know, 20 to 25% is really good, and it's going to continue to fuel the rally, especially being the biggest stock in this index. Nvidia also announced acquisition news. They're buying Shoreline.io. So again, you know, that's going to further add bullish demand, and they were up 3.51% year to date. Kind of crazy when you think about that, and actually up 0.7% here in pre-market. So very bullish for Nvidia. But with regards to the S&P 500, yeah, you don't want to be buyers or sellers at this level. I don't think the market's going to collapse, and I don't think we're going to see significant upside until after June OPEX. Once a lot of this negative gamma rolls off the tape at the 5500 level, then the market can freely move to do what it wants to do. But until then, we're seeing compressed volatility between the 5400 and 5500 area. So, you know, buy dips, sell rips to 5500 area, but the upside very limited from here. And just quickly on market breadth, we can actually see market breadth did improve ever so slightly. What we need is just a couple more days of equal weight right here, outperformance. Then we could actually see these move higher. If we could break some of these highs in the advanced decline line, maybe hit new all-time highs, then the advanced decline line would actually confirm the rally we're seeing right here, and then it's onward and upward for the rest of 2024. Breadth looked really bad right here, but we are starting to see improvements, and hopefully we could actually go ahead and hit new all-time highs in the advanced decline line. If we do that, onward and upward for the S&P 500. Yes, markets can rally on very thin breath, but it's far better if the majority of stocks actually participate in the rally, and hopefully we see that, and that would be stronger for stocks as a whole. Now guys, looking at the weekend poll, we do these polls every single week, so if you're not subscribed, go ahead subscribe so you can participate in these. I normally send them out every Saturday, sometimes as early as Friday night, but this week for the S&P 500, are you bullish, bearish, neutral? And 46% of you guys were bullish, a huge percentage of you were bearish, 15% of you were neutral. And as of the price action so far this week, definitely a win to the bulls. However, it is a shortened trading week, an OPEX week, and the week is still young. And right now you are bullish, retail is bullish, and so too are CEOs. CEO confidence has rebounded back above the 50 level, and we've seen a huge increase here in 2024, back above the 50 line, which is very positive. And this is simply because business conditions have actually improved in 2024. This is the business conditions index. Yeah, we've seen a little bit of sideways action, but you do have to take it in aggregate that most businesses do everything on a yearly basis. And in 2024, we've seen a huge rebound in business conditions. And we also know that S&P 500 companies are also producing those type of results. This right here is S&P 500 earnings surprise factor. Essentially tells us, did earnings come in better or worse than expected? And S&P 500 earnings saw a surprise factor of 8%. And pretty much what this means is if we're expected to report 10% earnings growth with an 8% surprise factor, that earnings growth is now 10.8%. You can see certain sectors, the big sectors, stuff like comm services, discretionary, healthcare, financials, all posting surprise factors of 10% and above. And that's what's really helped the S&P 500 so far this earnings season and in 2024. And every single sector has actually produced an upside surprise to earnings. This is very good and is one half of the reason why the S&P 500 is actually doing so well this year, because earnings are coming in very, very good, but also because future earnings are expected to be very, very good. This is S&P 500 consensus EPS revisions for the next 12 months. And you can see normally what happens is that on average, this is the median right here, is that earnings normally get revised to the downside about 8%. So let's say earnings are expected to be about 10% for the quarter. Normally revisions will take them down to about 9.2%, somewhere around there. So far in 2024, there's been barely any downward revisions. And this is part of the reason why S&P 500 is rallying. Normally we expect this. This is what we got. And that just makes for an incredibly resilient stock market. Now with S&P 500 companies making more cash than ever, where will they be spending that cash? Goldman Sachs expect in 2024 that S&P 500 cash spending will increase by 9% and companies will boost cash acquisitions as well as buybacks by 15% and 13% respectively. We'll also see an increase in capital expenditures by 6%, which is still the biggest component of cash spending, nearly $1 trillion here in 2024. And then dividends and R&D should see an increase of 6% and 9% on a year-over-year basis. So S&P 500 firms are definitely showing investors the money with buybacks and dividends, but that's not to say they aren't investing in growth. We're seeing record R&D investment, record cash acquisition investment, as well as record capital expenditures. Now let's switch gears and talk about liquidity. Now in recent weeks, we've actually seen the Eurozone come under quite a bit of stress, especially the equity markets, and that's because liquidity has actually deteriorated. We can see that it went from this turbo bid area into the bid area into this puke area, and essentially liquidity is now a net negative for European stocks, whereas the US market has actually seen liquidity come down, but we're still in the bid zone and we actually are leveling out. And that's why we've seen outperformance here in the US in the last week and a half relative to international indices. At the same time, looking at total market inflows, we can see non-US equity inflows for 2024 have totaled 69 billion, whereas US equity market inflows have totaled 99 billion. But the biggest beneficiaries of 2024 have actually been money market funds at 235 billion, bonds at 242 billion. But with regard to equity markets, out of the different long-short factor strategies, we could see that momentum, multi-factor, and size have produced the best gains year to date: 16.8, 12.7, and 8.4% return. Do take into consideration that out of all of these long-short strategies, momentum is the only one that's actually beaten the S&P 500. Every other strategy has underperformed the S&P 500, including dividend, value, and short interest being the worst, down 10% for the year. And that just goes to show in 2024, in this type of environment, it simply does not pay to be a bear. Let's talk about the economy. We got a survey here from Bloomberg. Economists were asked if they see the US entering a recession in the next 12 months, and these were their responses. 88% of economists said they saw a soft landing for the US economy, 10% said hard landing, no recession, and only 3% said they saw a recession in the next 12 months. This pretty much tells us that the contrarian trade right now is for a recession in the next 12 months, and consensus is soft landing. Very interesting data, and part of the reason why the economy has remained so resilient has been the labor market, but we are starting to see things cool off. After remaining at a historical low of 3.5% for almost a year, the unemployment rate has actually increased to 3.9%, slightly higher than the 2018-2019 average. This is when the economy was absolutely roaring, and this isn't necessarily a bad thing. I think the labor market is just normalizing, and we tend to see volatility in the labor market, much like stocks. We can extend, but then we do revert back to the mean. But if this does continue to the upside, do expect the Fed to react very, very quickly, because given current labor market and inflation conditions, the decision to cut rates is most sensitive to an uptick in the unemployment rate or jobless claims. This is the increase in probability of a rate cut if any one of these deteriorates by 1 standard deviation in a month. And you can see that the unemployment rate right here, as well as continuing claims, is the two things that the Fed is looking at the most. So if we do start to see the labor market deteriorate in a very big way, do expect rate cuts sooner than later, and intense rate cuts as well. The Fed are looking at two things when it comes to cutting rates. They're looking at the unemployment rate, the labor market, as well as inflation. Inflation data is coming down. That's supportive of rate cuts. The unemployment rate is ticking up, but still in a very healthy position. But if this starts to moon, they will cut regardless of what inflation does. That being said, I do believe the increase in the unemployment rate we're seeing is just normalization, and we're actually seeing this across various industries. This is the change in the unemployment rate since December 2022, and then contribution to total increase in the unemployment rate. And you can see that a contribution to the total increase in unemployment rate has been broad-based across all of the major industries in the US economy, from tech, mining, other services, finance and real estate, transport, all of the above. And again, this just points to normalization, whereas if we've seen a massive spike in one specific industry that was really contributing to the total unemployment rate rising, that would be more of an outlier factor. But I do remain convicted that the unemployment rate is just normalizing from its 2018-2019 trends. There's going to be ups and downs, and as long as we stay below, the 4.2% level, the consumer should remain strong and the economy should continue to grow. At the same time, something else we're seeing, just a consumer parameter, is TSA checkpoints continue to move higher. In the US, the number of travelers crossing TSA checkpoints continues to move higher and is up 6% year to date. We can see this right here was 2020. The COVID situation fell significantly. It has since moved up quite religiously, and we are up 6% here year over year on a year to date basis. And people only travel when they have money. Businesses only pay for travel when they can afford to do so. And this right here is a very, very encouraging sign. And by the way, this figure right here is at the 2018-2019 levels where travel was at its peak. Now let's talk a bit about seasonality. This is some very, very interesting data I thought I'd bring to you guys just with regards to what the S&P 500 is going to do over the next month. And pretty much this is S&P 500 performance from June 19th to July 23rd, when the trailing quarter, March 19th to June 19th, is positive. Now this is probably going to trigger as of June 15th. The S&P 500 is up 4.89%. It's actually definitely going to trigger, and we can see the returns 5 days later, 1 month later. Now 5 days later, it tends to be pretty negative. 8 wins, 21 losses, negative 0.58% return. But if we buy the dip, the next month tends to see outsized returns of 25 wins, 4 losses, 1.48 average return, 2% median return. And if we buy the dip, assuming we buy the low right here, the average low, we could actually look at returns of anywhere from 2.3 to 2.5% average return in the S&P 500 all the way to July 23. Now let's look at seasonality, presidential election year seasonality. Now equities typically rally following an election day as policy uncertainty is resolved. So this right here is election day. We normally see that we tend to rally in election years up until election day. We see quite a bit of volatility. Then we par a lot of those losses and then some into the end of the year. This is what we've done in 2024. We've brought forward a lot of the gains. It does not mean we can't go higher. We definitely can, because trend is more important than level. And you can generally see that from this point right here, the trend typically is up. So do expect further upside, not without volatility, but do expect the majority of volatility to come here on or before election day. But if you've made it up until here, thank you so much for watching. If you like this video, guys, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.